In an era marked by economic volatility and unforeseen challenges, the stability of the banking system and the security of our finances have become a major worry. Evaluating the resilience and ability of a bank to withstand adversities is crucial. The recent collapse of small regional banks such as Silicon Valley Bank and Signature Bank has sparked significant interest in assessing the financial stability of our banking system. In response, the Federal Reserve conducted a simulated stress test on 23 major commercial banks, each boasting assets of at least $100 billion, evaluating their ability to withstand severe losses. While the results were positive, questions remain about the reliability of these tests and whether they truly reflect a bank's resilience. Hi, allow me to welcome you to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Make sure to leave a like, subscribe if you're new to our channel, and turn on the notification bell to keep posted. With that being said, let's start. A simulated stress test was administered to 23 of the nation's largest commercial banks by the Federal Reserve Bank. Typically, the Fed conducts this test annually or biennially depending on the bank's size. In the past, people didn't pay much attention to it. However, due to the recent collapse of smaller regional banks, there is now significant interest in what's known as minimum capital requirements, essentially assessing whether the banks have enough funds to withstand adverse circumstances. The good news is that all 23 banks were triumphant when the Fed tested them using a simulation in which they suffered a hypothetical loss of $541 billion. The Federal Reserve determined that all the banks had sufficient cash to weather market downturn or economic shock. However, some people continue to have reasonable doubt over our nation's financial system, and others do not feel that things are going to work out okay during a recession. To recap, the Federal Reserve has made it more costly to borrow money by increasing interest rates in response to rising prices, commonly referred to as inflation. Prior to that, several smaller banks invested money in treasury bonds, which is a common way for banks to generate profits. They not only lend money but also invest our money into secure assets such as treasury bonds in order to generate income from collected interests. However, difficulties arose as a result of the Federal Reserve's decision to raise interest rates in an effort to combat inflation. It had a detrimental impact on the prices of those bonds, and consequently, the value of our deposits decreased as well. Because of this, panic ensued among individuals, leading to a collective desire to withdraw their funds from the bank simultaneously. This compelled the banks to sell their assets at a loss, ultimately resulting in the insolvency of some institutions. To prevent a recurrence of such events, the Fed aims to ensure that banks avoid making similar mistakes. They accomplish this by subjecting banks to stress tests, which assess the resilience of the financial system. These tests are categorized into 4 types: Type 1, Type 2, Type 3, and Type 4, based on the size of the banks. Type 1, 2, and 3 banks, which are sufficiently large, undergo the stress test annually, while Type 4 banks take the test every other year, although some may volunteer to participate. Banks like Bank of America, Barclays, Capital One, JP Morgan, and Wells Fargo were among the notable financial institutions that participated in this year's major test. All financial institutions are expected to maintain a certain level of capital, known in the industry as CET1 or Common Equity Tier 1. This serves as the bank equivalent of a savings account or piggy bank, protecting them from potential catastrophe. The bank's shareholders are the ones who put money in the piggy bank. The Federal Reserve, also known as the central bank, determines the amount of money other banks must hold in their reserves or piggy banks, which is proportionate to their size. Subsequently, these banks are evaluated based on their performance in the stress tests. The evaluation results in 5 different scores: well capitalized, adequately capitalized, undercapitalized, significantly undercapitalized, and critically undercapitalized. Banks that receive low grades face the consequences imposed by the Fed, such as limitations on lending capacity and restrictions on dividend payments to shareholders. In order to pass a stress test and be deemed well capitalized, a bank that is systematically too large to fail has to have at least 10% of its total assets stashed away in this piggy bank. The 23 banks recently examined needed to have at least $10 billion stashed away to be regarded as well capitalized, given that their total assets were more than $100 billion. Here are the findings from the simulation. The bank's reserves, represented by their piggy bank, decreased from approximately 12.4% to 10.1%. Surprisingly, this is considered good news because not all banks are required to maintain a 10% reserve. The passing grade or the best grade a bank can achieve is determined by meeting the minimum compliance level of 4.5%. Therefore, the test demonstrated that even if the banks were to suffer losses worth $540 billion, they would still be operational and able to provide loans to individuals. However, there is a significant caveat. The grade assigned, which is an A, represents the industry average. The crucial question remains, what does $540 billion actually signify? And what circumstances would need to unfold globally for the banks to incur such losses? How did the Fed arrive at this specific figure? Fortunately, they specify exactly what must take place. According to the Fed, the severely adverse scenario is a scenario characterized by a severe global recession with prolonged declines in both residential and commercial real estate prices, which spill over into the corporate sector and affect investment sentiment. The Fed provided more context by revealing the exact numbers for its worst-case scenario. According to their assumptions, the Federal Reserve projects that the unemployment rate would surge to 10%. This figure is notably higher compared to the current rate of 3.7%. However, it is crucial to question the reliability of these findings. Merely employing complex methodologies to assess a bank's safety does not guarantee absolute security. The safety of a bank relies on the variables incorporated into the equations, which are primarily based on the information available at the time. Thus, it is essential to recognize the limitations inherent in the assessment process and remain vigilant about potential risks. You may have a sense of safety within the confines of your home, but a breach could occur from an unexpected source you hadn't even considered. This is similar to the vulnerability that smaller regional banks face. Despite the presence of warning signs and knowledge of their weaknesses, these banks often go unnoticed due to their relatively small size. It is insufficient to merely identify which banks are potentially problematic. They must also be compelled to comply with and undergo the necessary stress tests. Fortunately, larger commercial banks provide a relatively secure environment for our money. In conclusion, the stress tests conducted by the Federal Reserve on the nation's largest commercial banks have shown that these institutions have sufficient capital to withstand a hypothetical catastrophic loss. This provides some reassurance in light of recent collapses among smaller regional banks. However, it is important to remain cautious and question the reliability of these findings. While stress tests serve as a valuable tool for assessing a bank's resilience, they have limitations and cannot guarantee absolute security. The vulnerability of smaller banks emphasizes the need for continued vigilance and compliance with stress testing. Ultimately, while larger commercial banks currently offer a relatively secure environment for our money, it is essential to stay aware of potential risks and ensure ongoing scrutiny of the banking system. Can your bank truly survive a catastrophic loss? Hi, it looks like you've reached the end of this video. Thank you for watching this far. Please subscribe and give a like if you enjoyed it, and comment your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you around!